Hello everybody, my name is Les Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Because of the time of increasing interest rates is coming due to inflation we've been experiencing in 2021, I wanted to discuss how interest rates increases affect bonds. So just to give you a background, bonds are loans to the government or to companies rather than ownership, which is stocks. Bonds are supposed to be safer and less volatile than stocks and often form the quote unquote ballast of a portfolio. They also pay interest, so produce an income. They produce a series of time payments. For example, you give $1,000 to the company as a loan and then get 10% interest payments every year or $100. Then after 5 years, let's say, you get your $1,000 back. The interest rate depends on whom you're loaning your money to. Safe government bonds pay less interest than a medium-sized corporation would, and longer term bonds pay higher interest because there is more time for something to go wrong and the corporation could be unable to pay back interest or the principal. When interest rates go up or are expected to go up, that's when things get interesting because new bonds start paying higher interest, let's say 12% or $120 a year in our example. So when you buy an ETF or a mutual fund with bonds, those bonds internal to the ETF or mutual fund get traded often. So you'll experience the following. Because of the increased interest rate, the value of existing bonds in your ETF or mutual fund takes a hit because compared to new bonds, the old bonds pay less interest, only 100 rather than the 120 that the new bonds pay. And so the old bond's value is less when your mutual funds trades them. This is because the old bond's owner is missing out on 5 times $20 payments compared to the new bond. So the old bond needs to be discounted by roughly $100 and so is worth roughly $900. The discount on the $20 coming from the year 5 interest is less because of the future payment has a lower present value than the year 1 interest payment, but it still counts. Longer term bonds will take a bigger hit from an interest rate increase than shorter term bonds because of the higher number of payments and the larger number of dollars you are missing out on. During times of inflation and rising interest rates, short-term bonds, treasury bills, and money market funds in general are thus safer because they lose less money when interest rates increase. But these pay very little interest to begin with. So you're better off putting your money into an online bank with 1 or 2% return and having it be easily accessible. So I avoid bonds these days because one, interest rates are very low and will likely go up, especially if the inflation is going to be around, and the existing bonds will therefore lose value. And two, the interest rates the bonds pay are low because the general interest rates are low. So I'd rather buy dividend stocks. You should check your risk profile and decide whether bonds will make you money in the long run, but it seems like bonds will have a tough time going forward. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.